Statements of cash flow. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exam. Simulate exam conditions and practice. In this lesson, we learn everything about meaning and importance of cash flow statements, how and why are companies required to include a statement of cash flows in their annual accounts, how to prepare a statement of cash flows in accordance with IAS 7. Altogether, we discuss and practice questions based on these concepts, identify and practice examination questions. What is a statement of cash flows? A statement of cash flow is one that lists the cash flows of a business over a period of time, usually the same period as they covered by the income statement. A cash flow is any increase or decrease in cash in a business. Cash includes cash in hand and deposits repayable on demand, less the overdraft which are repayable on demand. For our purpose, deposits and overdraft will generally be balances at and overdraft with banks. The word on demand means either immediately, example, current accounts, or within 24 hours of giving notice of repayment. Why statement of cash flow are important? While it is necessary to know how much profit a business has made, profit is not cash in the bank. The business does not pay its suppliers from the balance on the retained earnings account. Suppliers are paid from the money the bank has in its bank account. No business has ever been forced to close down by its suppliers or trade papers because it made an operating loss. But a business can be forced to close down because it has insufficient money in its bank account to pay its debts when they fall due. This is known as being insolvent. The amount by which the ready money in a business exceeds its immediate liabilities is its liquidity. There is a big difference between profit and liquidity. A business may make a large profit but finish up with less money in its bank account at the end of its year when it started with. For a period of time, business needs to generate cash inflows that at least match its cash outflows. Cash inflows include money received from issue of shares or capital but put into the business by owners, loan received from banks or other lenders, money received from the sale of surplus non-current assets, payment from customers with trade receivables for the goods sold to them, interest received on deposits with banks and other companies. Cash outflows include payments to suppliers with trade payables or other creditors as already mentioned, and the running cost of carrying on the business, example wages, renewal of and additions to non-current assets, interest on loans and debentures, payment of tax on profits, payment of drawings for a sole trader or partnership, costs involved in the growth of business expansion and development, dividends payable to shareholders or drawings of sole traders and partners, repayment of loans or redemption of shares by the company. Statement of cash flows and limited companies. The International Accounting Standards, which covers the structure and layout of the statement of cash flows for limited company, is IAS 7. This requires that limited companies produce a statement of cash flows as part of the annual financial statements. The statement provides any guidelines for the format of statement of cash flows. This statement is divided into 4 categories. Operating activities, the main revenue generating activities of the business together with the payment of interest and tax. Investing activities, the acquisition and disposal of long-term assets and other investing activities. Financing activities, receipts from the issue of new shares, payment for the redemption of shares and changes in long-term borrowings. Reconciliation of the opening cash and cash equivalents at the start of the period with the closing cash and cash equivalents at the end of the period as a result of the net cash in or out of during that period. At the end of the statement, the net increase in cash and cash equivalent is shown, but at the start and end of the period under review. For this purpose, cash is defined as cash on hand and cash on hand and bank current accounts. As mentioned earlier, cash equivalents are short-term investments that can easily be converted into cash, such as money held in term deposit account that can be withdrawn within 3 months from the date of deposit. Bank overdrafts, usually repayable on demand, are also included as part of the cash and cash equivalents. Format of the statement. Operating activities. The cash flow from operating activities is calculated as profit from operations, profit before deduction of interest and tax, add depreciation charge for the year, add loss on sale of non-current assets or deduct gain on sale of non-current assets, add or deduct changes in inventories, trade and other payables, less interest paid, less taxes. The figure calculated now has to be adjusted for the following items. Depreciation charge for the year. This is adjusted by adding it to the profit from the operations figure. The reason for this is that depreciation is non-cash expense. No money enters or leaves the business for depreciation. The effect of the depreciation charge was therefore to reduce the profit, but not the cash generated from the trading operations of the business. Loss on sale, disposal of non-current assets, or profit on sale of non-current assets. If it is a loss, then it is to add it back to the profit from operations. The reason for this is that the loss on sale of non-current asset is not the cash generated or taken to our disposal. If it is a profit on disposal, then it is deducted from the figure for the profit from operations. Again, it is not the actual cash generated from the sale of the non-current asset. The effect of the profit has been to increase profit from operations. Changes in inventories, trade and other receivables or payables. These to be treated as the addition or deductions to the profit from operations. To work out whether the adjustment is positive or negative, it is necessary to compare the value of inventory, trade receivables and trade payables in the opening statement of financial position with those in the closing statement of financial position. The difference between the two figures is the adjustment which will be made. If the inventory has increased over two period, then money must have been spent to buy extra inventory. Thus, the difference between the two figures is deducted from profit from operations. If on the other hand inventory has gone down, the money has been saved. This is positive adjustment for the business. If the trade receivables have increased over the two accounting period, then money has not been collected from them. Thus, the difference between the two figures is deducted from profit from operations. If on the other hand they have gone down, then this is a positive adjustment for the business. If the trade payables have decreased over the two accounting periods, then money has been spent paying them. In this case, the difference between the two figures is deducted from profit from operations. If on the other hand they have increased, then this is positive adjustment for the business. Interest paid, which also has to be deducted. Taxes paid on income, usually corporation tax. Taking all these items into account when preparing the statement of cash flows of the business, the section on cash flows from operating activities will look like this. Investing activities. This is calculated by including inflows from proceeds from sale of non-current assets, both tangible and intangible, together with long-term non-current assets. Outflow from cash used to purchase or non-current assets, both tangible and intangible, together with other long-term non-current assets. Interest received, dividend received. Financing activities. This is calculated by including inflow from cash received from the issue of share capital, raising or increasing loans, outflow from repayment of share capital, repayment of loans and finance lease liabilities, dividends paid. Reconciliation of cash and cash equivalents. Net increase or decrease in cash and cash equivalents for the year. Cash and cash equivalents at the beginning of the year. Cash and cash equivalents at the end of the year. Set out below is full statement of cash flows from a limited company, taking all the above into account. So this is how a statement of cash flow will appear. So it will start from operating activities. So it will start from profit from operations before tax and interest. So this is the starting point. Profit from operations before tax and interest. To that we have to add adjustments for we have to add or deduct whatever. So depreciation charge for the year will be added. Increase in inventories will be subtracted, decrease in trade receivables will be added, increase in trade payables will be added. So that will give you cash used or cash flow from operations. Interest paid during the year, tax paid during the year, that will give net cash used in or from operating activities. Cash flow from investing activities. So that this is the second part in this. So purchase of non-current assets, profit from sale of non-current assets, interest received, dividend received. So all these here have a link, has an access with investing activities. No, that's why they are coming here. Then next, that will give net cash used in or from investing activities. So then the next one is Cash flow from financing activities, proceeds from issue of share capital, repayment of long-term borrowings, dividend paid. So all these will be either added or subtracted. So that will give you cash used in from financing activity or cash flow from financing activities. So if you add all the three, this one, and this one, that is cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, the net amount will be net cash used in net increase or decrease in cash and cash equivalents. So to that, when you add cash and cash equivalents at the beginning of the year, that will give you cash and cash equivalents at the end of the year. So this and this will be appearing in the balance sheet. This amount is the amount which you get after you work out all this adjustments. So whatever. So when you do all this, you get this figure for 81,500. So this is from balance sheet. This is from balance sheet. How to prepare a statement of cash flow from statement of financial position and an income statement. Statement of cash flows are prepared by comparing the amounts for items in the latest statement of financial position with the amount for the same items in the previous year's statement of financial position. Some additional calculations for non-current asset details will be required. The following example with the explanatory notes demonstrate the procedure. The statement prepared are set out below. Prepare workings. The following information will be required but probably not be given in the question. Non-current assets, cash paid for new assets or received from the sale of old assets, amount provided for depreciation in the income statement, profits and losses on the disposal of non-current assets, dividend, interest and taxation paid. This information is best discovered by preparing rough T accounts as the workings and calculating the missing information as balancing figures. Second step, once all the workings have been done, the statement can now be prepared. Step 2. Prepare a statement of cash flow from the year for the year ended whichever. So net cash flow from operating activities, there is no different. This is no different to the process described in section 23. Start with the profit from operations before interest and tax. Then adjust for non-cash items in the income statement. This is those items which do not involve the movement of cash, such as depreciation on profit or loss or disposal of non-current assets. This figure will come from earlier workings. Increase or decreases in inventory, trade receivables and trade payables. This is done by comparing the figures for each of the two statements of financial position. Remember that if the inventory has increased between the 2 years, then the company must have spent cash acquiring the extra inventory. This means that it will have a negative effect on the cash flow of business and will appear in the brackets in the statement. Likewise, if the trade receivables have increased between the 2 years, this means that the company has not received cash from its customers. This too will have a negative effect on the cash flow of the company and will appear in the brackets in the statement. If on the other hand the trade payables have increased between the years, then the company will have saved its cash by not paying its suppliers. In this case, the change will not appear in brackets in the statement as the cash flow will have benefited from this action. If these situations are reversed, then treat them opposite way around in the statement. Interest payment made during the year. Take care if as it may be that a loan was taken out partway through the year. Alternative, perhaps not all the interest will have been paid during the year. Check the closing statement of financial position to see if there is any accrual in the current liabilities. Tax paid during the year. This will come from the workings above. Familiarize yourself with the workings to example. Check whether all the figures come from and how they are calculated. All non-cash items in the statement must be adjusted in the reconciliation of operating profit to net cash flow from operating activities. Make sure understand the effect of changes in inventory, trade receivables and trade payables on cash flow. Part 2. Identify the items which form the cash flow from investing activities, purchase and sale of non-current assets, interest and dividend received. Part 3. Identify the cash flow from financing activities, receipts from issue of shares, cash flows spent on repayment of loans and dividends paid. Learn the format of the statement and which items go where, under which headings. Don't worry when you get to the end if it doesn't balance. Insert the figures for cash and cash equivalents at the start and end of the period. Prepare the statement of cash flow in outline, leaving plenty of space between the headings for details to be inserted. Start by filling in the easy items such as payments made to purchase of non-current assets, proceeds of disposals, issued in redemption of shares and debentures, movements in inventory, trade receivables and trade payables, etc. Then proceed to the items requiring more detailed calculations. Advantages of producing a statement of cash flow. The statement of cash flow is an extremely useful addition to the annual account. The advantages to a business producing one are: it shows the movement of cash for the year. It also allows the business ability to generate cash from its trading activities. The ability to generate cash is vital to the future survival of the business. Cash flow is easier for a non-accounting person to understand. We will all look closely at our cash and bank position. This means it is easier to understand that an income statement and statement of financial position, which rely on technical knowledge and are prepared using accounting conventions, which do not apply to cash. Some players are more interested in a business ability to pay them when how much profit it makes. Remember, cash and profit are different things. It provides useful links as a backup to the income statement and statement of financial position. The only real disadvantage of producing a statement is that it ignores the matching concept. This means that the cash coming in or going out may relate to a previous accounting period. However, the advantages of producing a statement process are far more beneficial to the business. It allows another element to assess the overall performance of the firm.